Kia ora and Happy New Year. Welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name's Patrick Smillie and I'm the editor at BusinessDesk. Today on Shared Lunch, we're joined by Sharon Zollner, who's the chief economist at ANZ Bank, and Simon Robertson, who's worked all over the world in investment markets. Talk about what we might expect on the economic front in 2024 and what that could mean for global share markets. But before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording. I'm
going to start with you, Sharon. 2024 looks like another difficult year. What are you expecting, very broadly?
Well, we're expecting the economy, as you say, to go through some more hard yards. We actually suspect that maybe activity might have bottomed in terms of the weakest quarter that we saw with the GDP unexpectedly falling in Q3. In fact, we had some data out this morning that suggests the last year may have actually ended on a bit of an up note. But the labour market lags the real economy by about 6 months. So things are likely to continue to feel worse for some time yet. So I'm not sure that 2024 will be a year that people remember fondly, but perhaps the worst is past.
What could we expect in terms of, there does seem to be a bit of a sense that by the end of this year, we should be starting to see some kind of almost like business cycle upturn. What would be the harbingers along the way that would be the key indicators for that?
Well, typically in the business cycle, you see the goods production sort of things picking up first. The more lagging indicators are the likes of retail, because it takes some time for the monetary policy impacts to feed through, with looping through the labour market as well. So it all does take some time. Of course, this is an unusual recession in that it's been deliberately caused by the Reserve Bank as the unpleasant medicine in order to get rid of inflation. So I guess the first milestone we have to pass is the Reserve Bank feeling confident that inflation is beaten and lowering the OCR. They're not going to do that on a whim. So if they're comfortable doing that, then I think we can be comfortable that the economy can recover without the Reserve Bank feeling the need to knock it on the head again.
Yeah, I think we're probably a bit early to ask you whether you think it changes or gives you a clear view as to when we might see a first cut to the OCR, but I presume you're still expecting to see that at some stage this year. I think that I wouldn't have thought there's anything in the latest stats which suggests that we're going up.
Yes, well, the Reserve Bank, of course, sounded surprisingly hawkish in November, and technically, actually, their path for the OCR put the burden of proof on give us reasons not to hike, though that their language was more, we won't hesitate to hike if we get any more nasty surprises on inflation. As it turned out, of course, within a couple of weeks, they got that weak GDP data, which was not only a surprisingly weak third quarter, but actually downward revisions. So the market decided at that point, game on, and brought the pricing for a hike forward to May. Now, there are nuances there insofar as it doesn't mean the unemployment rate was higher back then than we thought, or that that the output gap necessarily was a lot more negative than we thought. So the market perhaps takes a slightly binary view. GDP lower means rate cuts sooner. It's not that simple. There's lots of moving parts. But fair to say there was a meaningful downside surprise to the Reserve Bank. And so I think the market reaction was definitely in the right direction. What the Reserve Bank is going to make of it all, we don't have another monetary policy statement until the end of February. But interestingly, the Reserve Bank has actually put out a notification that in an upcoming speech, the chief economist will talk about the recent data that's come out since the monetary policy statement. And so that will be very interesting because that has not been their modus operandi in recent times. They've just reiterated the messages from the last public statements and said you'll have to wait and see. But this is an unusually long gap over the summer, 12 weeks rather than the usual 6. So perhaps they're thinking that's just a little bit too long to not give the market some kind of heads up on how they're seeing the data. But insofar as they're not getting the Monetary Policy Committee together they can't say anything too substantive about what it's technically going to mean for their next set of forecasts. But no doubt the market will hang on their every word. But of course, the data today was a bit mixed. The quarterly survey of business opinion, but overall, I think the vibe is that they are making more progress than they thought. In November, they're like, why haven't we had more impact on the economy? And then GDP data resolved that conundrum, for example. So in that regard, yes, it is looking absolutely like the next move is a cut and sometime this year, but the exact timing of that remains very uncertain.
If we zoom right out, and Simon, you might want to jump in here as well with Sharon, and look at the global economy, because obviously what happens in New Zealand is all very well, but the World Bank is reported as saying that we're probably 3 years into 5 very difficult years. They're talking about the 2020s as a wasted decade, presumably as a result of having had cheap money for about 12, 13 years and now having expensive money again, or money that actually costs something. What are we expecting from the world this year, from the global economic front?
If you're looking at I think the most important thing out there is, as Sharon indicated, is rates and what's happening with rates. And you saw it play out in Q4 in the equity markets. So the Fed signaled that rate cuts might be coming, and you saw a very sharp rally in the US and across all markets globally, including in New Zealand and Australia. I mean, both those markets were down going into the last quarter, and then Australia ended up 8% for the year, and New Zealand remained flat. And we saw the US market, particularly the tech sector, rally very, very hard. And so I think you're in a situation where you have two sets of equities out there. You have the Magnificent Seven, for example, which are full of cash, very sensitive to rates, and rallied very, very hard last year. And then you have a number of companies that are still burdened by debt and will struggle until rates come off significantly. The difference between this part of the world and the Northern Hemisphere is that most of the companies that have bonds, much like New Zealand, people have mortgages that have rolled off. The tenure in bond portfolios that are in companies still have a long way to go before they actually start ticking through and going up. So I think you're going to have a split market, much like we did last year as well.
Sharon, at a macro level, global economy, what are the other than rates? I guess we've got 2 or 3 wars. And the possibility of a Trump presidency at the end of the year. Put all of those things together, what comes out in the wash?
Yeah, there's plenty going on. In terms of the global economy, from the New Zealand context, that certainly has a very, very heavy weight on China. And China is the black sheep at the moment. They are actually battling what could become an entrenched deflation problem. Kind of analogous to what happened to Japan. When their real estate bubble popped and their population was declining. When your land prices are falling consistently, the real estate boom caused by monetary policy is your house price falling a little less quickly than it was before. That's not going to get anyone excited in spending. So monetary policy becomes quite gummed up, and you can actually get stuck in a deflationary situation. And the risk is that could happen to China, given their population is falling far faster than Japan's did, and their real estate valuations have been highly elevated, one could say. So the risks there are very different. For now, at least, the consumers seem to be quite cautious about spending unnecessary money on nice to haves, and New Zealand exports do play in that space. That's where you get the price premiums for being a more towards the luxury end, but it's also where you get demand being very sensitive to how people are feeling and about their job security and that kind of thing. So obviously the US economy matters hugely to China, but our actual direct trade with the US, for example, isn't that great. The channels through to the New Zealand economy tend to be through China on the macro side, and of course directly in terms of financial markets. It's a bizarre situation, but where what happens to the US job market can have as much impact on our fixed mortgage rates as what's happening to the New Zealand labour market in a very sort of in a daily sort of sense, which is a bit of an odd situation that I think the Reserve Bank of New Zealand sometimes finds a bit frustrating. But certainly there's plenty of wildcards on the global stage, as you mentioned. There's geopolitical risks. For starters, there's just generally the same battle that's going on here. Central banks are attempting to slow down spending in order to bring down inflation and having quite a lot of success. But until they declare victory and ease up, then clearly global growth is going to remain under pressure.
So one of the advantages that the US has is because China's such a large trading partner, it can actually import deflation. And so, if it was completely necessary, you could see a situation where tariffs perhaps lighten off between the US and China, and you import more deflation. What's quite concerning at the moment is shipping prices globally because of the incidents that are happening in the Red Sea. And Europe's much more vulnerable to that than the US, because the US can go round the other way and probably raise shipping prices 10%. But European shipping prices, because of what's going on, are sort of up more closer to 30% at the moment. So they're going to have more inflation pressures relative to the US.
Do you have a view about what this interplay of factors might mean for our exchange rate, and therefore A, inflation, and B, export and tourism performance?
We're forecasting the exchange rate to just rise fairly modestly from here and sort of stay in a sort of 60-65 band. It's been doing its job recently, which is more or less tracking dairy prices, essentially taking the edge off the commodity cycle, sharing the joy and the pain around. It's been driven also by the US dollar, which has been almighty for a time there. Generally, it trades as a risk currency. We are a small commodity-producing nation, dependent on China and reliant on foreigners to fund our lifestyles, and we're running a large current account deficit as well. So really, I think the outlook for the New Zealand dollar is probably going to be dominated by things that we don't know about yet. One suspects, but all else equal, we think the currency is not wildly out of line with where the current macro fundamentals would say it should be.
I mean, Patrick, one of the things that's really important this year is we've got 50 elections around the world, and a lot of those are really important countries across Europe and North America. And we've had Argentina already, we've had Taiwan last week, we've had our own election, and we've got a lot more coming up that are very important, from Brazil to India to Mexico to South Africa to Russia, Germany. And so there's going to be a lot of volatility around those as a backdrop for markets.
I'm pretty sure we know who's going to win the Russian election, but the American election is certainly looks as if it's going to go Trump's way. It's all us soft, wet liberals in Wellington wring our hands about this, but is it necessarily bad news for the New Zealand economy if there's a Trump presidency?
I'm not sure it made too much difference to our business cycle last time. Obviously, anything that makes global trade more difficult is unhelpful for New Zealand, and that is unfortunately a bit of a trend. The America won't put judges on the World Trade Organization board. That basically it's quite toothless, and so we've seen a sharp rise in non-tariff barriers to trade. And food security issues, you might think that would make everyone lower their tariffs on food so they can import it nice and cheaply, but no, it actually tends to lead to countries putting their tariffs up to protect their domestic agriculture sector. So the going is pretty tough in terms of, so I'd certainly say the low-hanging fruit has been picked in terms of free trade agreements, and free trade doesn't seem to be a Trump priority. I think it's probably fair to say, but he's not alone in that.
Yeah. It does strike me, though, and maybe this is something you'd have a view on, Simon, that New Zealand, not necessarily only its listed companies, but New Zealand is becoming a little more interesting to American money over the last sort of 2 or 3 years, partly as a result of geopolitical trends, partly perhaps because we're doing some things well. What degree of, offset almost might we see from greater interests out of the US and US economic resilience offset against the inevitable weakness that seems to be coming from China?
Yeah, I think if you just look as simply as how many cruise boats we've got coming into the harbour now, I think we've got over 100 coming in this year. We've just added United back on, and so we're getting more tourists out of the States. And I think there's still lots and lots of people who think this is a fantastic part of the world to live in, and it's safe. And we'll continue to get wealthy Americans come down here. I mean, if you go north, you're seeing lots of golf courses being built by very wealthy Americans, which is fantastic for the economy. And so I think there's more homes for more capital down here in terms of investing in it being a great lifestyle.
I mean, one for both of you, how much does a new government make a difference either to economic sentiment generally or the kind of economic settings which would encourage both more domestic investment and perhaps more foreign direct investment?
Well, it certainly has a big impact on business confidence. In fact, the NZIER actually estimated the impact on their headline business confidence measure, which matches the one in our survey pretty closely, and they estimated it's worth 27 percentage points. Their business confidence increased an awful lot more than that, which shows there is definitely an upturn in the economic cycle as well. But I would say generally the population tends to overestimate the impact of who's in charge in terms of the short-term economic cycle. I mean, obviously, you just look at North Korea versus South Korea. Government policy really, really matters for your economy. But in the short business cycle term, it's a very slow ship to turn. So within the current government is obviously very, very keen to cut spending in some areas, but also very keen to deliver tax cuts. So it remains quite unclear at this point, fiscal policy's contribution to inflation pressure, how that's going to change over the year ahead.
Yeah, look, I tend to agree with you. It's hard to move big things in different directions, but I would throw in that, Christopher Luxon has lived offshore. He likes going and meeting leaders. He was very disappointed not to be able to go to APEC. He's already been to Australia, and I think he'll very much lean in once he's got New Zealand buttoned down a little bit more and start heading offshore and trying to build out those international relationships for our country.
Yeah, interesting. The other sort of key indicator, I guess, or milestone will be the budget in May. Do you have a view, Sharon, as to how credible it is to think that the government is actually able to make the kinds of cuts that they've talked about in election and coalition agreements, and also deliver meaningful tax relief?
Well, mathematically, when you look at how spending has grown over recent years, even relative to the size of the economy and the size of the population, then yes, it must be possible to make those cuts. But of course, it's one thing to look at it and say, clearly we can easily make cuts, and then go through line by line and figure out the economic and the political cost of every cut you want to make. Of course, it gets much more difficult, and potentially also, of course, there could be some downside to tax revenue as well, depending on how the economy goes. Could be some upside as well, but the Treasury forecasts were reasonably optimistic. So if they get any downside surprises on revenue, that'll lower their options still further. There is a real tension there where our government debt is still low in an international comparison, but it's an awful lot higher than it was, and debt always reduces your options going forward. And we've obviously got a lot of fiscal challenges ahead with climate change and an ageing population, just for opening bids, quite big structural challenges going forward, as well as just the usual business cycle dynamics. So we do need some fiscal headroom, but it's easy to say, hard to do.
I mean, I suppose one of the levers that New Zealand has, which not many people talk about that often, is migration. So, we used to run migration at 10,000 people a year. And then we sort of moved to closer to 10,000 a month during the key government. We increased the size. We increased the size of the population by 1 million plus over that period. And I wouldn't say there's too many countries in the world that have increased their population 20% in a decade. And so it's very hard to do and move the lever when you're a large country like Australia even. But we do have that tool, but you've got to think about the housing and the infrastructure and the schooling and everything else that goes with that lever.
Yeah, indeed. So it's a real, it's going to be a real challenge because we had an infrastructure deficit before we let in all these people. So, and that's going to require government spending. So on the one hand, you'll get more revenue from these extra workers earning, but you're also likely to see higher unemployment than you would have if we hadn't boosted the labour market so much. And they need schooling and all of these things. So it's no free lunch for fiscal policy, nor for the Reserve Bank. Indeed, the Reserve Bank estimates that net migration is on balance inflationary. On the one hand, it'll put downward pressure on wages, but on the other hand, it will raise rents and potentially house prices and prices more generally. Some of that unexpected optimism in the retail sector is likely due to population growth. Because, the shop doesn't care if it's a new New Zealander or the old New Zealander coming back twice. They just see robust demand. Of course, it's a sugar hit because eventually there will be more shops when there's more people. But the number of businesses tends to be a bit slower to rise. So in the short term, that can be quite a meaningful boost to demand per shop.
And what's your sense as to whether we're going to see this level of migration continue? It doesn't seem to be anything in policy terms which would necessarily say it should stop, other than perhaps a bit of a slowdown. And ongoingly from that, what are your thoughts about house prices, residential property prices this year?
Yeah, so that the debate in New Zealand about the current levels of migration has been surprisingly muted, given we've just had an election. Even some players who traditionally have made a lot of noise about immigration have not done so. Whereas in Australia, they're starting to have more of a debate about, whoops, have we overcooked this? I presume that will come. But even apart from potential policy tweaks, the fact is that the labour market is weakening. The economy has weakened and the labour market tends to follow that with a lag of about 6 months. You can already see job ads have come off a lot. The number of applicants per job has exploded. And at the end of the day, a lot of people need a job offer to get a visa to come to New Zealand. So the numbers are already dropping away and we expect they will continue to do so. And insofar as we're already seeing stories about workers, particularly in construction, who have arrived and discovered they've got no job or their job is gone. And if they can afford a plane ticket, they may well leave again or may have to leave again. If they leave within 8 months of arriving, it'll be like they never came. They'll be revised out of the arrivals numbers. If they leave after 8 months, it would be an arrival and then a departure. But either way, given the state of the business cycle, it seems likely that the population in a year's time will not be as high as it looks currently like it is going to be. We'll have to wait and see. But it's certainly going to be higher, a lot higher, and all these people do need somewhere to live. And we've already got severe housing shortages in the likes of Tauranga and Queenstown, for example, are the two most extreme examples. Auckland made huge inroads in closing its housing shortages during the COVID period, where we had negative net migration and built more houses than we had ever done before. But now you look at consents, which are going down, and population, which is going up, and you can do the maths on the back of an envelope and figure out we are indeed now rapidly eating into housing supply and worsening housing shortages again. So that will be a tailwind for house prices, as will the changes to tax policy that the new government wants to make, which will increase the financial return for housing investment compared to otherwise. But the biggie is of course interest rates, and there is the potential, if the market runs away with the idea of large imminent cuts, that you could actually see pretty meaningful falls in fixed mortgage rates and give the market a second wind. So that sort of concern, I think, probably was one of the reasons that the Reserve Bank came out banging its drum very, very loudly in November, and why it'll be so interesting to hear the comments that the chief economist has to make in his speech at the end of this month, because that battle of wills going on. Expectations of OCR hikes helped the Reserve Bank when they started the hiking cycle, because it meant mortgage rates started going up before the OCR. But now we're in the symmetric case where markets anticipating cuts could cause monetary conditions to ease and the housing market to lift before the Reserve Bank is really ready for it too, before they're convinced that they've gotten inflation beat. The fact is that these pricing indicators fell a lot, but many of them are still at levels that are not consistent with inflation where it needs to be yet. Getting there, but the job isn't done yet.
Yeah, which does lead us, though, to investment themes for 2024. Simon, in a way, it sounds a little bit like, back to the good old days. Interest rates start to fall, so putting money into term deposit doesn't seem like quite such an obvious, easy option. House prices start to rise, so the national hobby of buying and selling houses to one another starts to look attractive again. Sitting where you are, how do you think a New Zealand investor should look into the year ahead and look for pockets of opportunity which might not otherwise be obvious?
I think if we look at Q4 and the rally we saw in Q4, The concerns are that we have had the rally because we've seen rates coming off, and that's the expectation. That's why we got that rally. So as always, it's sort of, which moved first, the horse or the cart? And so we're going to have to wait and see how that balances out. In terms of, New Zealand, we had a year that was flat last year, and if we look to the States, we've had a NASDAQ, which is up 40. We've had an S&P 500, which is up 25, and we've had some incredible single stock performances, and companies like NVIDIA up 260%. We've had Meta up 200%. We've had everything in the Magnificent Seven up a minimum of say 40%. And these are the largest companies possibly in the world, but certainly in North America. And so I think, North America always turns around fastest. It has very, very agile labor markets. It's got 50 states which all compete against each other, and you have labor mobility move around. We're seeing a lot of migration out of the West Coast going into places like Florida and Texas. And the US just bounces back, clears inventory, can hire quicker, and it embraces technology much, much faster than anyone in the world. And, that'd lead me on to talk about AI. I mean, we've had AI around since ChatGPT just over a year now. And we're seeing, the Europeans put in regulation. This morning, Australia said they're going to regulate sensitive and high-risk areas of AI. And I think we're just getting started. And if you look at these big sort of decade cycles that we've had, where we've had technology come along, whether it was sort of chips and electronics in the 60s and the 70s, and in the 80s we had the PC, in the 90s we had the mobile phones, and we had in the 00s we had the internet. I think we're with AI in one of these Cambrian moments again, where this is something that's incredibly impactful, that's going to be around and have very, very exponential effects on businesses going forward. And there's a lot of talk about what it's going to do to the world of software as a service, for example, where people can start building applications using co-pilots. We don't have GPT-4 down here, it's blocked. But I'm told that GPT-4 compared to GPT-3 is just an incredible leap up in terms of what you can do. And so there's that saying out there that, AI is not going to take your job, but someone who's using AI will be better at you. And so that's why you need to embrace AI. Very important.
So in that scenario, are there sectors which are either shielded from that? Are there sectors which are particularly vulnerable to that, and who might best benefit?
Well, I think Microsoft is the best positioned. It did a fantastic job with ChatGPT and OpenAI and doing a deal with Sam Altman, which ultimately reversed back out after Sam Altman got kicked out of OpenAI. Companies like Google have got to reinvent what they've got in terms of search so that people don't go off Google search and their ad business falls away. Google, has got thousands of engineers who are incredibly smart and have already got AI products in Bard, which are great, and they'll have to learn how to manage those bumps. And so the big tech companies will all embrace this very, very quickly. And then if you drop down a level below that, then you've got semiconductor companies, which have had a fantastic year, NVIDIA being the extreme example with its chip. But ASML and Applied Materials and other chip companies in that food chain have done very, very well and will continue to. Companies that are going to struggle again, SaaS companies, people who are coding, people who are doing functions in the background. There will be efficiencies that will be gained that might not require so many people or might create competitiveness and lead to prices being dropped. So you think of anything that you use as a SaaS product on your desktop, they are going to have to embrace this very, very quickly. And then, there's companies like Lind, which is a very large company in Europe, which does industrial gases, which is right at the heart of the world of hydrogen, which will do very well in the industrial space. In, say, the healthcare sector, the largest company in Europe is Novo Nordisk, who's in the middle of the GLP-1 drug Rage, which is, a diabetes drug that is helping obesity. And so that will be very defensive. Companies in the financial sector, which is the third largest sector in the US, like JP Morgan, are very, very diverse in terms of fixed income businesses, banking businesses, stock trading businesses, financing businesses, lending businesses. You've got very broad businesses and will benefit as rates come down, and have not performed that well during the last cycle.
So if you're sitting in New Zealand and you want exposure to where that growth might come from, where that opportunity is, where do you look in terms of New Zealand-based investments, or do you look offshore? Or is where are the opportunities for people here who maybe want to keep their currency hedged against the currency by investing in New Zealand dollars?
Well, I take a step back, Patrick. 65% of the world's markets a representation of equities are in the S&P 500, and 30% of those earnings are actually outside of the Americas. So if you're buying the Americas, you're essentially getting a lot of global exposure anyway without having to go into specific markets. If I look at New Zealand stocks, and a handful of them around the other way, you've got Fisher & Paykel, which has a fantastic offshore business, especially in North America and Europe. You look at Mainfreight, it has a large and growing offshore presence. You look at Xero, it's expanding into Commonwealth markets all over the world. So we have a number of players that have that exposure. And then on the flip side, we also have a number of defensive businesses down here, albeit in our power companies or our healthcare. And we talked about aging populations before, so it plays into a very long-term thematic. And then we have a whole lot of developing, emerging companies that are private down here, who are predominantly offshore and moving offshore. Rocket Lab is a classic example. They won a $500 million contract from NASA the other day. They've put 41 rockets into the sky, and they've landed on the moon for NASA. An incredible story. They have what is an incredibly unique asset in terms of a launch pad down in New Zealand. There's only a handful of them around the world, and most of them sort of get used by Elon Musk and Jeff Bezos before we get a look at them. So that's an incredibly unique asset, and Peter's building a bigger rocket. So that's the New Zealand side of things. And then if you go back to the States, I'm convinced that the best companies in the world reside in North America, predominantly. I've got a pair of Nikes on. I've got an iPhone charging over there. I got an Uber here today for this. I watched some Netflix last night. I'm going to get on my laptop later, which is IBM, probably made in Taiwan, and in China. But I'm going to get on my laptop and I'm going to use Microsoft Outlook, a fair part of the day. And, I'll jump on some search engines, which also come out of the US. So I think that, the US have this suite of companies up there which are market leaders, have enormous TAMs ahead of them, have CEOs that allocate capital incredibly well. In most cases, they have very wide moats around them. And they continue to adapt constantly.
It's a bit of a segue, but I'm sure a lot of our audience will be interested. The ability now to trade crypto in ETFs. What's your take on that? I mean, I declare myself a crypto skeptic. I've always thought it's just money without guarantees, but maybe this is a bit of a game changer.
Yeah. So on the 11th of January, the much anticipated, allowance of ETFs with crypto backing behind them got the tick from the SEC, and we now have 11 tokens or 11 ETFs trading, for a mere few days now. What I think it's done is it's legitimized Bitcoin. For me personally to go and buy some Bitcoin, I'd have had to have gone on board a wallet. I'd have had to get a safe to put my key in, and I would have to have sent some money off to somewhere, and there's no sort of 0800 number to call if something goes wrong. We've seen what's happened with Sam Bankman-Fried and that vehicle, and I think it's not quite the same, but gold ETFs got launched in 2000. gold was different because you could go buy a sovereign and you could go buy a block of gold and you could put it somewhere in a safe in your house or store it somewhere. So you physically had it, so you got comfortable with that. But when you've got like the likes of BlackRock and the likes of, ARK providing ETFs, and you have confidence that there's surety and there's backing there, it's become much more interesting. And I think a lot of people will like that. If you look at the size of Bitcoin, it's a $900 billion asset. It's the 9th largest company in the US, if you were to call it that, behind Berkshire Hathaway. Australia, for example, is a $1.5 trillion market cap ASX. And so it's certainly not small. Estimations are that we're going to see $50 to $100 billion of buying through wealth management industries for clients in 2024. And so it's on the radar. It's arrived. There's some technical things happening with tokenization soon, which will be more interesting to follow. But it's certainly been, it's been crystallized now and legitimized, and it's easy for you to ring up Sharesies and get a little bit of exposure to a token and go, that's where I'd like to put some of my wealth.
Right. Okay. I can hide no longer. Look, we're probably starting to run out of time, so I'm going to ask you both the unfair question, which is, what's the big thing to take away from a conversation we've had today? Maybe Sharon, if you're thinking about the New Zealand economy this year, what's the big thing?
Oh, it's got to be inflation still. Is it beaten? Is it all over bar the shouting? That's what markets are desperately keen to believe. Central banks, for obvious reasons, are more cautious. The risk of holding rates too high for too long, they can just cut them faster and go, oops, oh well, never mind. If they cut rates too soon and then have to try and haul the market back for a second round, that would be so much more difficult. And so just the nature of those two risks means I think that this battle of wills between markets and central banks has got a way to play out yet.
Yeah. Simon?
Yeah, we're on New Zealand. I agree with Sharon. But, I think what's going to be really, really important is just to see how good Christopher and his team are and what they can get done. And I think it's great that he's got a 100-day target and he's got a big list of things to do, and we can put, ticks and crosses and sort of, shades of grey beside those and just see how quickly he can move and his team can get through this list they've got.
Hey, look, thank you both very much for your time today, and thank you everyone for tuning in. You'll find Shared Lunch wherever you get your podcasts. Leave us a 5-star rating and a comment with who and what you'd like to hear about next. Enjoy the rest of your week.